Welcome everyone to our webinar about artificial intelligence in portfolio construction. For the next 45 minutes or so, we will talk about lessons learned from about a century of research in asset allocation and portfolio construction, and also share latest developments. This webinar will be a discussion between academics and practitioners on this topic. And indeed, we have a few guests here today with us, Tommaso and I, who I will introduce in a minute. My name is Yvonne Pichert. I'm one of the business developers at MDOTM. Also to say that this webinar is part of our webinar series called Frontiers, where we share research and breakthroughs in investment management with leading academics and industry experts. And indeed, today is our second of that series. And as I said, we will talk about artificial intelligence in portfolio construction. So let's welcome our guests, Brian and Alessandro. And I'm going to stop sharing here to show that we are all here online. Let me introduce, first of all, Brian Guck, who is president of Guck International and vice president at Liberty Cove Investors, after having spent many years as global equity portfolio advisor at Wellington Management, where we actually worked together for several years. Brian brings a mixture of academic and practical experience to the subject of asset allocation. He has worked with large institutional investors on 6 continents while at Wellington Management, and he brings a global perspective to investment issues. I'd also welcome Alessandro Sbuelz, who is professor of quantitative finance at Università Cattolica del Sacro Cuore of Milan. He works in the faculty of banking, finance, and insurance sciences, and his research focuses on asset allocation and asset pricing. And of course, we have Tommaso Migliore, who is the CEO and co-founder of MDOTM. So let's continue. So before we go into our panel discussion, just a few minutes on MDOTM and who we are. At MDOTM, we believe that with the exponential rise in computing power and also the reduction in cost of computing power over the last few decades, as well as the availability of large amount of data in financial markets, artificial intelligence has the potential to play a key role in the future of asset management. We are a firm that specializes in developing artificial intelligence for the application in investment processes. And as such, we consider our mission to bring understandable AI to portfolios of institutional investors. We consider ourselves one of the European leaders of artificial intelligence in investing. And we are a company of about 30 people, combining finance veterans and creative innovators. We partner up with 5 universities that helps us with our research efforts. We have about more than 50 research projects completed. And we currently work with institutional investors whose assets under management come to around 600 billion euros. Our company at the moment, we advise assets of about 700+ million. And, sorry, I can't see this. And we offer basically, we offer 3 different solutions to integrate artificial intelligence into investment processes, just very briefly at the top in the box from left to right. On the one hand, we use our artificial intelligence to conduct portfolio diagnostics, so helping review portfolios for risk exposures and efficiencies. We use our AI also for tactical asset allocation enhancement, which provide tactical allocation recommendations to broad institutional portfolios. And on the far right, what we call portfolio advisory, where we use artificial intelligence to construct stock picking portfolios, both on the equity side and in multi-asset space. So for today, a quick look at our agenda. We'll give a brief review over a century of asset allocation research. We will be talking about what we call a new era of assistant decision-making. And finally, we'd like to explain how we can build understandable AI that is useful in investing. So let's start with Alessandro. I'm going to ask a few questions to the panelists, and at the end, if any of the attendees have questions, there will be time for questions as well. So Alessandro, the last century of literature in portfolio construction has seen thousands of research papers and dozens of models proposed to assist investment decisions. Could you help us with a brief overview of developments in portfolio investment theories and describe the developments over time, please?
Absolutely. Portfolio theory has a long history, which is fascinating and of massive relevance for the current asset management industry. I'll offer here a glimpse of such a history. The origin of portfolio theory is related to the beginnings of probability theory. The mathematician Daniel Bernoulli was in 1738 one of the first to highlight that investors' risk aversion downplays the appeal of a risky gamble, even if the gamble has a huge expected payoff. He also pointed out that risk aversion justifies risk reduction via diversification across several risky gambles. 200 years later, the American economist John Barr Williams ostensibly believed so much in risk reduction via diversification to advocate the dividend discount model for stock valuation with discount rates deprived of risk premium. The dividend discount model is a leading device for value investing. The investment template fathered a decade later by Benjamin Graham, as the dividend discount model can be an effective tool in spotting stocks that are underpriced vis-a-vis their fundamental value. In 1952, the Nobel Prize winner Harry Markowitz, who is a key founder of the modern portfolio theory, had the brilliant insight that through diversification, risk can be reduced, but not generally eliminated, without changing the expected portfolio return. Now, the expected portfolio return is made of the expected returns on the single securities selected in the portfolio. In the 1960s and the 1970s, the Nobel laureate William Sharpe and the great distinguished financial economist Stephen Ross provided an explanation of the single expected return based on the exposure to systematic market risk or to systematic common risk factors. The explanation of the cross-section of expected stock returns has been refined by the Nobel Prize winner Eugene Fama together with Kenneth French in the 1990s, and they proposed an identification of the systematic common risk factors: market, size, value, and later also profitability and corporate investment. Other relevant risk factors like momentum, liquidity, and quality have been then unearthed by financial economists. Several results from the research on portfolio theory in the last decades have been, I think, aptly summarized in the 2015 book titled Efficiently Inefficient by the Danish economist Lasse Pedersen. He states that expected returns originate from markets that must be inefficient enough to justify the existence of active professional investors who are able to work out risk-adjusted alpha and get compensation for their portfolio choice work. At the same time, markets ought to be efficient enough to make it difficult for every investor to generate outperformance. I'll conclude with three important aspects of portfolio construction that remain currently open to intense debate. The first is the time variation of expected returns, that is, return predictability. The second is the algorithmic implementation of large optimal portfolios. And the third one is the risk management of large portfolios. Artificial intelligence has been recently providing asset managers with a clear advantage in many different areas, including those three aspects. So return prediction, portfolio optimization, and risk management.
Thank you, Alessandro. This was super interesting. Turning over to you, Brian. We just retraced the steps of the modern approach to portfolio management. You have been working in the asset management industry for many years. Can you tell us about how portfolio management theory has been applied in practice, and possibly also address what role technology has played in this, please?
Thank you, Yvonne. I would like to start my brief comments with a quote from John Maynard Keynes. I think it's relevant to this discussion we're having. And Keynes said, "Practical men who believe themselves to be quite exempt from any intellectual influence are usually the slaves of some defunct economist." So we have here in front of us, as Alessandro has explained, many outstanding defunct economists. Well, they're not all defunct, but we have a wonderful history of academic research, intellectual sparks, and ideas that are now the foundation of all of the work that practical men in the management of finance rely on, whether they know it or not. And so I might just say that I think all of this research prior to roughly the early 1980s, late 1970s, was essentially in the academic realm. And it was with the introduction of modern computing capability with, let's say, the first IBM PC, the Apple computers, and more affordable mainframe computing capability, that financial analysts and academicians were able to take this vast 200-year history of financial data and actually start testing the practical application of these theories. So we have, for example, with Eugene Fama, Eugene Fama is famously known for coming up with the concept of the efficient market hypothesis, which essentially says that all information that we know about companies and markets and commodities is automatically or instantaneously incorporated in the price of those securities, which means that there is an efficient portfolio and that active investors are unable to add value because new information is very quickly converted into pricing for individual stocks. That insight started to become or became the beginning of the debate about active versus passive portfolio management. This debate was theoretical until in 1974, Jack Bogle created the first index fund. In 1974, December 31, 1974, Jack Bogle created the first index investors trust. Later in the 70s, Jack Bogle also created the Vanguard Group in Malvern, Pennsylvania. Today, the Vanguard Group is a multi-trillion-dollar investment management company. I think it's the largest investment management mutual fund organization, at least in the world. And the S&P 500 index fund that Vanguard offers has a current value of $500 billion. The concept of active versus passive was developed pre-computer, but became real and live post-computer. This is another debate that continues to be, very active in the academic and the practical side of the investment community. I would say also from this nexus of computing power and academic brilliance, we had Capital International in Geneva was able to bring to the world the first coherent set of global equity indices with data on all of the constituent companies within those indices that was updated on a monthly in the beginning, but now daily basis because of the introduction of computer technology. And finally, I would say that we have all of this wonderful risk theory, starting back with Bernoulli, but it wasn't until the 1980s that Bar Rosenberg in California started to develop actual risk models that could be applied to real live investment portfolios. So portfolio managers in the 1980s were beginning to get the tools that allowed them to assess their risk relative to the market, relative to factors like growth or value or size, large cap versus small cap, and so on. It took until 1990 for the Barra Group to develop what they called the global equity model, the GEM model, which was the first risk model that was applied to the total world of equities, the MSCI World Index. And so I think what we have here is a wonderful academic history. The practitioners and the academicians have taken the available computing horsepower and proven or disproven many of these theories to make them more practical in day-to-day use. So I think that's that's my perspective as sort of an early academician and a later practitioner on this evolution and this wonderful history.
Thank you, Brian. So I guess we've seen how technology has been applied to investing, and it is really built on top of solid foundations on the academic side. Turning forward to today, turning to Tommaso, artificial intelligence is entering a lot of different industries, is starting to enter the financial world as well. So how would you fit in artificial intelligence in this backdrop of academic and modern portfolio theory, Tommaso?
So it is a very interesting, topic to understand why we talk about AI in investing today, when we have on the screen something that was, a picture that was taken in the 50s. So why are we talking about today about AI in investing? Well, for the same reason that the Wright brothers took off with their first plane 500 years after Leonardo da Vinci theorized the flight. This because of two reasons. Reason number one, theory. Even though Leonardo da Vinci flight machine are very fascinating, they're really not very similar to a modern airplane. And the shape of the wing are much more similar to a bird rather than a flying machine. That's one thing. And the other thing is technology, both material technology and energy technology. There wasn't really a way to put a powerful enough engine that was small enough in a robust and light environment, which was the first Wright brother plane. So the same thing happened with AI. In the 1950s, it was theorized. This picture, which is, I believe, fantastic, is when actually the terminology AI, artificial intelligence, was born. But then it took basically 50, 60 years before computers were really fast enough to process the data. And at the same time, theory caught up. So now we know why a neural network is learning what it is learning, and what are the mathematics behind to make that process. So it is very, very similar. But when we move from AI in general into the world of investing, we have to think that talking about AI in investing, it's putting together two different paths. And if we move forward with the slide, we can clearly see that this story begins earlier than that. Begins actually in the 1930s. The title of this webinar is actually, stepping on the shoulder of giants. And really, we are doing so because at the beginning of the 30s, in the 1930s, we actually saw the first application of the regression analysis by Fisher and Pearson. That was the first time in which really different mathematical techniques were applied to the world of investing. And that actually is the same area in which we can start talking about econometrics, just like we know it today. Then just after that, thanks for Enrico Fermi, we saw the first application of Monte Carlo simulation. So you see that, the very foundation around artificial intelligence, which is advanced statistics, actually have a very long history into the first development. And then we move through from, as you can see with the orange line, for basically almost a century, going through the ARMA models, the random walk theory, the ATP model, the GAR process, the co-integration of Engel and Granger. And at the same time, whilst the econometric world, the mathematics applied to investing was becoming more mature, at the same time, the technology was getting better. Since the 1950s, we saw an increase into application of technology in general. Whilst the AI really wasn't there, but machine got better. And in fact, the next slide, which is called From Econometric to Assisted Decision Making, really see where everything at the end of the day meets. At the very top, we started to accelerate on having a better understanding on how to apply different mathematical perspectives to the world of investing. And at the same time, on the technology behind the green line underneath, computers started to support decision making. Now, even though it wasn't really artificial intelligence, it was just a mere computing power. But in the 1997, we saw the first time in which a computer won against a person, Kasparov, at chess. And then in 2015, that was the real revolution. AlphaGo, an algorithm developed by Google, won at a very complicated board game, which is called Go, which requires decision-making capabilities more than just computing power. So why everything comes together today is the same reason as I said before with Leonardo and the fly. The theory, the orange line, got better and advanced into development. And at the same time, technology got faster and cheaper. And if we move forward one slide, we can clearly see that in one full picture. And basically, as you can see below, just over the last 2 decades, the computing power has multiplied by 1,000, and the cost has been reduced by 98%. So this is why today we're talking about this. What does it mean, though, to stand on the shoulder of giants? It means that also we have a better understanding of how to apply AI to investing. Often it's believed that one of the ways just throw data inside of a system, and hopefully the system is able to grasp information. Now we'll talk deeper about this thing more in deepness after a couple of minutes. But in general, it's really interesting to understand one thing. What AI is, it's econometric on steroid. It's really having a very good understanding on the basis of econometrics, so statistical models, and just allow this model not to be always pointing in the same direction. Meaning that, for example, if you just measure any data in finance, you're always stuck with such a complicated problem, how long you look in the past, for example. Now, all this flexibility can be really incorporated by these new techniques, whereas traditional econometric kind of struggle to cope with this complexity that the financial market do have.
Thank you, Tommaso. I think that's a great segue into the next question I wanted to address to Alessandro, who mentioned before one of the 3 open issues in finance is the issue of predictability of expected returns and the uncertainty around that. And I guess that's the nature of the financial markets in general, that often there are shifts in market regimes that make it very difficult to predict expected returns, and which address one of the fears of investors who actually prefer certainty and reliable outcomes. So if we think about what Tommaso just talked about, statistical models, traditional models, based on your experience, what does your experience tell us about traditional or static models? Are they becoming obsolete? And how can artificial intelligence-driven models add value in this context?
Thank you, Yvonne. The data generating process of securities returns is likely to be transmuting over time because of temporal metamorphosis in the deep underlying price relevant forces. Now, following such mutations is vital for the performance of model-based investment strategies. The estimation of traditional quantitative models typically needs assumptions of stationarity, which hamper their ability to catch up with the structural gyrations of the data generating process, and the introduction of predetermined regime shifts in traditional quantitative models brings only partial respite. By contrast, artificial intelligence-driven models are flexibly built to keep track of those structural gyrations, thanks to the continuous learning loop that goes from training data to the test data and back via the adjustment of the algorithm hyperparameters. Also, the elimination of human biases is another main benefit of AI-driven investment decisions vis-à-vis decisions made on the basis of traditional quantitative models. Humans not only struggle to process all the available data, they also have cognitive and emotional biases. That is, a tendency to shape models and perceive information through a filter of personal experience, attitudes, and emotions. This can make decisions less objective and jeopardize financial performance. Created to make rational decisions based on objective criteria rather than emotions, artificial intelligence does help investment managers to eliminate many of their human biases. However, human oversight is essential in AI-driven decision processes, I think. Chiefly, artificial intelligence algorithms learn by themselves from data sample selected by humans, who must then be keenly aware of selection biases. Also, a human manager must be in charge to handle issues like the low representativeness of data samples, or the incorrect framing of a problem, which may lead to unintended outcomes. In a nutshell, artificial intelligence has become a very useful tool to help avoid human bias, but must be always properly combined with human supervision.
Yes, that sounds, very much sounds to me like financial markets are increasingly becoming very complex and difficult to maneuver. Turning over to Brian, you have been, as I said, around in investments for a long time. What would you say, is the financial markets becoming more complex? Do we have to change our models, or what would you say, what are the cornerstones of investment decision making? Has there been a change, or do we go back? Where would you place yourself?
Thank you, Yvonne. I think certainly the markets are becoming much more complex. There are many new and different portfolio offerings or investment ideas being brought to the investing public and the institutional investors around the world. But I think if we go all the way back to Mr. Bernoulli, the one thing that has not changed is the power of diversification. And I think for institutional investors, this is a very important piece of foundation stone or bedrock upon which to build an investment program. Institutional investors around the world represent very different, they have very different objectives based upon where they are, what country they're from, what their legal structure is, what their regulatory environment is, and so on and so forth. Could be a pension fund, could be a sovereign wealth fund, could be a central bank fund of some sort, but they all have different risk and return parameters around them. But as they continue their efforts to diversify into things like private equity and debt, securitized loans, absolute return strategies, commodities, real estate, farmland, timberland, quant strategies, never-ending variety of hedge funds, the diversification becomes almost overwhelming. And many of these strategies that are added to a simple cash, stocks, bonds portfolio, which is what we were thinking about in the 50s with all of the theoretical discussion, these portfolios become so overwhelmingly complex that it is very hard to make realistic tactical asset allocation decisions to respond to shorter term conditions in the market. And it's impossible because either you can't trade the securities or the portfolio because it is illiquid. You may be locked into a long-term contract with a hedge fund, for example, or the cost of trading these large complex portfolios overwhelms any potential gain that may be achieved by making those trades. And I think there is some great potential for AI to provide sort of an oversight or an overlay of maybe a derivative run portfolio or something that would allow for shorter term asset allocation or tactical asset allocation decisions to be made by these large pension funds and endowments and foundations and central banks and so on. They would be able to make some shorter term tactical asset allocation decisions without disturbing the long-term policy portfolio that is the foundation of all of their work, that is built on this sound, strong theoretical background. So there may be a role for AI to optimize the policy portfolio over shorter tactical time periods in response to changing market conditions. And that would simply improve the return and maybe also reduce the risk of these very large and cumbersome portfolios. It's like trying to, turn an aircraft carrier on a dime, virtually impossible, or an oil tanker, even better response. Aircraft carriers are a little more nimble than large oil tankers, but once you're at sea and you're going for your next destination or your next waypoint, it's pretty hard to turn that thing if you see a small boat in your path. That small boat is in jeopardy because you simply cannot change course. And large portfolios are like that. And if you had an AI TAA kind of structure on top of it, you might be able to make some shorter term course corrections and improve your outcome both on the risk and the return side. So I think that's how I would see things moving forward today.
Thank you, Brian. Very, very interesting. So turning the microphone again to you, Tommaso, what are the essentials of developing reliable and understandable artificial intelligence in this context, would you say?
So first of all, not going back to what we said during the webinar, but it's really having a very, very good understanding of all the theory that brought us to today. AI is not, throwing data inside of a system. I say it again. It's really having a very good understanding on what the practitioner did based on the academic theory, and use the flexibility of the parameters as an advantage. This is the benefit of artificial intelligence. It's not really to come up with some crazy new theory, some crazy new portfolio construction theory. It's really knowing where the value lies within the theory that we have already. Most of them are pretty basic. We have a very good understanding over the many years that we use them, but we also know all the limitations. And just to name a couple, Monte Carlo simulation, for example. Monte Carlo simulation, if you think about it, is fascinating. It's trying to bring a dimension of error within your prediction, effectively. There's no prediction, there's just error, because otherwise it would become some sort of a Black and Litterman methodology. What's the problem with Monte Carlo simulation? It's very parameter dependent. The moment you start twisting the values inside, you alter the value yourself. So that presents a problem. And the problem is the human in the equation, or the way into you interact with these parameters. So problem number one. Black and Litterman, another good example. It's fascinating, the math that allows to combine the variance and covariance metrics with a different return, with a different vector of expected return. But once again, if you measure the impact of changing just a few percentage points, the expected return rather than the variance and covariance metrics, you realize that the value is in the expected return, and once again in the human. So you see that we came across a lot of different ways into trying to make more robust the investment process. But every time we've done it, we faced one of the problem that is the problem, if not the problem of scientific investing, if you will, which is how you give the data into the machine, and you have to do it. And the moment you do it, you alter the result. So where we see that AI really brings value is that you can be less invasive in this process by allowing the system to vary, to explore all the different granularity within this input. And this is how you build a robust model. Then, of course, there is all the monitoring, the making sure that the ongoing learning process is coherent. Just to give you an idea, at MDOTM, we have a dedicated function which is called mission control, that is just there to make sure that this process runs smoothly. But this is just risk management at the very end. To make a robust and reliable model, you have to start from solid foundation. And starting from solid foundation means really climbing on the giant that's, that really set a wonderful path for us to just add a little bit, even though that little bit might make quite a substantial difference ultimately.
Absolutely. So maybe I'll pose one last question to all three of you, and then we can turn over to any participant questions. But I guess one of the fears that a lot of people have when being presented with artificial intelligence is that of machines taking over. And many fear that as soon as artificial intelligence becomes the new standard in investing, alpha might even disappear and humans might become redundant and obsolete. What do you think about that fear or concern that people might have? Starting with you, Alessandro, maybe.
Thank you, Yvonne. Well, I think that the heterogeneity of artificial intelligence-driven investment strategies, say different portfolio criteria, different asset classes of interest, does not go, this heterogeneity, in the direction of creating conspicuously crowded trades with all their implications for price pressures and for thinning expected returns. We know that the measurement of the alpha in an active portfolio return depends on the risk factors and on the benchmark returns that are being used to capture risk premium and style. Hence, the alpha's very appearance depends on how we measure it and is unlikely to fade away. As Lasse Pedersen has been pointed out with the notion of efficiently inefficient markets. Finally, the structural gyrations of the data generating process for securities returns I've been talking about earlier, which artificial intelligence is built to track via continuous learning, make the previous point on alpha's measurement, I think, even more relevant. And that would be my brief answer to your important point. Thank you.
Thank you.
I would agree completely with everything Alessandro just so eloquently said. And, you know, investors, the managers of large pension fund portfolios, as I said earlier, all have different return and risk objectives. There is no homogeneity out there in this world. It is very heterogeneous. The application of any technique, whether it's AI or any other quantitative technique, is specific to a particular portfolio and investment objective and investment program. There is no overarching homogeneous application of any of these ideas to the entire world. And as Alessandro said, this is mostly a measurement issue. You know, you pick a benchmark, you outperform it. You pick a different benchmark and you underperform it. So there's quite a bit of gaming going on in the practical world of investment management to get the benchmark that you can most regularly outperform. You know, if you compare yourself to something else, you're less good as an investment manager. So it's a measurement game in a way. And the other thing I would say is that Schumpeter famously came up with this wonderful idea of creative destruction. And the world's economy and our stock and bond markets are living examples of this ongoing, never-ending process of creative destruction. New ideas, new companies are forming, new technologies are coming every single day. And there is no way we can, ahead of time, anticipate the major changes that are taking place in our global economy. And so you know, we're not living in a static, or some people call it a sustainable financial world. There's nothing sustainable, in my view, about financial markets. They are constantly changing, constantly dying, constantly being reborn in new and different ways. And this is why this industry and business is so fascinating, to me at least, because it is ever changing, always reflecting the current and future state of competition globally and technology and human creativity, really. This is an industry that directly reflects the beautiful thing that is the human mind, the creative human mind. And so as long as our minds are continuing to create new and different ideas and theories and technologies, alpha is going to be there all the time for those that seek it out, are early enough in the game to seek it out. And so I'm not worried about this question. I think it's a softball kind of question, as we would say over here.
That's good to hear. Tommy, any last thoughts?
I mean, yeah, I mean, there's everything has been said, and I totally agree. I would just add one thing. First of all, the financial market, it's a market, and to function, that type of market needs to be competitive. It cannot be an oligopoly. So because liquidity would not be there, you would be the market. So structurally speaking, it's really something that we can be super, super safe. It's never going to happen. What it will happen, in my opinion, is that the market will become even more efficient. Just, in a similar way as similar phenomenon to what has brought, for example, the high frequency trading to the general market. Markets are more liquid, markets are even more efficient. So going forward, in my opinion, it's going to be a positive impact, but the alpha chances will always be there. And just to throw in a nice quote, records are there to be broken, and it's the same thing altogether, even in the financial markets.
Very true, very true. Well, thank you very much for your insights. I need to check with my colleagues working in the background if we do have any questions. If you do, please feel free to also put them into the chat. So let's see if any of the participants would like to ask you something. Yeah, so one question has come in here. Do environmental risks enter into the algorithms you're building? I guess, Tommy, that's for you to address.
So environmental risk, if they are within the algorithm, I mean, not directly. But I think, they're in the data that we analyze, definitely, but there's not a specific risk. About environmental risk, though, there is an interesting paper that we collaborated into publishing, which is around really understanding the risk premia behind ESG investing, and if green investing or brown investing. So it is once again in the theory behind, and the findings are really interesting, where brown investing should yield better returns compared to green investing, because there are associated environmental, legal, and other sorts of risk. Even though latest numbers don't show, still don't show that, but that's what we can expect going forward. So once again, I think that it's clear that AI is not the answer. AI is a powerful tool that will be the future of this industry, no doubt about it. But the theory behind it's always the where we come up, where is the starting point. And so this is why for example, environmental risk whatsoever, they're not really detected by any system. They're really part of the analysis and research process that we do beforehand.
Thank you. I think there was another question coming in just now, which addresses, it's not very clear, but addressing, to what extent is the artificial intelligence that we use at MDOTM to build our portfolios forward-looking? What is the forward-looking component in artificial intelligence-based investing?
So this is to me, but I'd like Brian and Alessandro to jump along. I mean, I'll give a philosophical answer, because I think it's good to also understand how we make decisions. We make decisions based on information, based on experience, sorry. And often we think this guy, this girl is really good because he's really experienced. Experience means he's lived a lot of things in the past. So you immediately realize that what is the forward-looking component in human decision-making? The forward-looking component in human decision-making is through basically how we interpret past experience, past things that happened. Okay, so what we do is we realized on what has happened in the past. We don't just copy and paste. We look at that with a critical eye, and through imagination, which is really just connected in a non-linear way, different experience in the past, we can project that in the future. And that's how human, makes a decision. And that's the forward-looking things that we have as human. How a machine does it is slightly different, but has a lot of analogy. It is slightly different though, because a machine has got zero imagination. But what it has the capability of really not forgetting anything and really working within the deepness of data. So a good example, a good exercise that we can all do is if you were to think what are the last top 20 significant events over in the financial market over the last 20 years. I mean, to name 10, it's already tough. You go 2008, 2020, low volatility in 2018, and already you're thinking, I need to stretch to get to 20. Okay, even though we use imagination and we project that in the future. Okay, a machine knows everything, so it's similar because it's a non-linear connection within those episodes in the past, and that's how it's a forward-looking process. So you see that, we get to the same point in a different way. And you also, at least my answer also covers another thing. What is the difference between and the value between man and a machine? Because us as human, we have imagination and we connect different points in a non-linear way to project something in the future, we're good at making long-term decision. Where it's just a more tactical approach, shorter term, that's where the machine really overpass the human, because it can leverage the deepness in the data. So this is my take on this topic. I don't know if Brian or Alessandro wants to have a different perspective on this.
I think, Brian, would you like?
No, go ahead, Alessandro.
Okay, thank you, Brian. I think Tommaso was spot on. Look, the data generating process produces future observations, right? So obviously the data generating process comes from the interaction of players with their objectives, preferences, constraints, but is what we are after when we try to predict the future, when we try to be forward-looking. So anything that helps us in tracking the nuanced changes in the data generating process keeps us on the frontier, or keeps us on a good standing in terms of forward-looking. So machine learning and in the techniques that are associated with the artificial intelligence do go in that direction. And also in terms of capturing important aspects of optimization, artificial intelligence is able, for example, to reduce the noise driven instability in the estimated covariance matrix that must be inverted to be implemented in optimal portfolios. And also artificial intelligence really handles signal-induced instability in the estimated covariance matrix, which whose inverse gets importantly into optimal portfolio. So we avoid singularities, we avoid exploding matrices that create unstable portfolios. So even when, like we know that optimal portfolios are properly constructed to exploit our forward-looking ability via the expected returns properly constructed, so the prediction of returns, but the artificial intelligence renders stable portfolios that are able to exploit that forward-looking ability. And I think this is massively important. Thank you.
Yeah, I would agree again with Alessandro. I just think that for us as individuals, we take our life and our life experience and we try to build on each day that we have so that we become better decision makers about whatever the issue might happen to be. That is a difficult process. speaking for myself, I mean, maybe I get better I know I get better at making certain decisions, and I'm not so sure about others. But I think it's interesting that this learning that we are capable of as individuals does not seem to be generationally transferable. I think this happens in investment management firms. I mean, and I've seen it. I've worked in, very large and excellent investment management firms, and you see it with the next generation coming into the firm. Portfolio managers, research analysts, they are reinventing the wheel every single generation. And AI and these other machine learning techniques should allow us going forward to do a better job of passing on institutional knowledge and history to the next generation, so they have a little bit of a head start in their professional decision-making process, at the very least. So
yeah,
there's a heck of a need for this kind of technology.
Yes, absolutely, absolutely. A couple more questions have come in. Maybe we take one or two more, mostly directed to you, Tommy, actually. I think this one is a very interesting one. Has artificial intelligence enabled you to identify non-traditional, less exploited risk factors compared to traditional factors such as value, momentum, etc.?
More than, I mean, the factors themselves, they're pretty obvious. I mean, we now talk about, we love to refer about factors, but they're really, really obvious, most of them. So more than, finding peculiar, non-exploited factor that's not really the case. Also because, if we even look at, those, multiple factor model, the Barra models, the Barra factors, etc., some of them are really recursive. They tend to be almost a little bit auto-referential. They go back to themselves. What's interesting though, it's how you define them individually. So having a better, we like to think that the market is like a big table with a lot of bubbles within. Okay, there's a bubble of pockets of different risk premium within. How you define the pockets, yes, that makes a difference. But really, to claim that those are or like to name those missing pockets, it would be a little bit too much of a stretch, because given that the market is such a complex environment. To put boundaries around areas, or to create these pockets, they have to be wide enough so that even if market conditions do move substantially, they are still relevant. Otherwise, they would not really be risk premia. They would be some risk premia that they just pop up and then fade away after a few moments. So that's why factors in general tend to be obvious and quite vague. How you define them, especially from time to time, that's where we feel that AI brings a benefit, and there's a difference to be achieved.
Excellent. Well, thank you very much again to all three of you for the interesting discussion. Now my phone is ringing. So I would conclude it here. I will bring up our presentation one more time, if I can. 1 second, because I do want to give you the topic of our next discussion, the next webinar that is coming up. As I said, we are doing this as a series, and just go quickly here. There we go. So the next, of course, it doesn't work the way I wanted to. So we talked about the role of the human being, people in artificial intelligence. And in fact, that will be the topic of our next webinar, which should be in about a month from now. And where we talk about the role of mission control. Mission control at MDOTM is basically our team that monitors our artificial intelligence on a daily basis, and also acts as a risk monitoring and risk management tool. So that will happen on July 15th, and we would be very happy to welcome everyone who has an interest in hearing to that. Thank you again to all the participants, and have a great afternoon.
Thanks a lot.
Thank you.
Thank you so much to everyone for being present and listening. Thanks.
Yes, indeed.
Likewise.